Datavault AI Inc. is currently trading at 1.56 USD, down 0.075 or 4.60% on the day. Now, on the surface, a 4.6% drop on a microcap stock might seem like just another day of volatility. Most retail traders, perhaps looking for quick Robinhood stock trading opportunities on the Robinhood app, might see that and either buy the dip or sell to avoid further losses. But what's truly interesting today isn't just the price, it's the context of why it's moving. This isn't a simple profit-taking pullback. This move is happening against the backdrop of a company that has been firing off press releases and acquisition announcements at a dizzying pace. And the market is clearly in a state of deep confusion, trying to figure out what this company actually is. The common belief, the expectation when you hear a name like Datavault AI is that you found the next small-cap AI darling. You think of the narratives that drive NVIDIA stock or the platform strength of an Apple stock. You expect a clean story about software, machine learning, and scalable, high-margin recurring revenue. The reality, however, is that Datavault AI, or DVLT, is one of the most complex, multifaceted, and frankly speculative stories on the NASDAQ right now. This isn't a simple software play. This is a sprawling story involving acoustic science, Web 3.0, digital twins, NIL or name, image, and likeness licensing, carbon credit tokenization, and a rapid-fire acquisition strategy. This is the kind of stock that would give a robo-advisor like Schwab Intelligent Portfolios a complete meltdown. It's the definition of a high-risk, high-information demand investment. The 4.6% drop we're seeing today isn't a reaction to a single, clean data point. It's the market's ongoing, agonizing struggle to price a business model that is changing by the week. We just saw the stock fall hard over 8.8% just a couple of weeks ago on October 28th, when the company announced a definitive agreement to acquire API Media. Now think about that. A company announces an acquisition and the stock falls. This is a classic sell the news event, but it's more than that. It signals that investors aren't sure if this is a strategic purchase or a desperate diversification. The expectation is that an acquisition adds value. The reality is that the market fears dilution, integration risk, and a lack of focus. This price action is happening in a very specific context. Let's look at the recent trading history. The stock has been on an absolute roller coaster. We're talking about a 52-week range between 25 cents and over $4. Just in the last 90 days, the stock ran up over 200%, an incredible move that brought in a lot of momentum traders. But in the last 30 days, it's given back over 24% of its value. This is not the slow and steady compounding you'd look for in Fidelity mutual funds or Fidelity ETFs. This is a trader's battleground, plain and simple. The daily swings are intense. The volume we're seeing today is significant, suggesting that this 4.6% move has real conviction behind it. This isn't just a few SoFi Invest users placing small trades. This is a recalibration. When you see this kind of volatility, you have to ask what the institutional players are doing. And the data here is fascinating. Institutional ownership is incredibly low, sitting around just 5.9 million shares held by about 41 institutions. Big names like Vanguard and BlackRock are on the list, but their positions are tiny, likely part of broad index funds like the Fidelity Extended Market Index Fund. The largest holder is Anson Funds Management, a hedge fund, which tells you a lot. This stock isn't being held by Fidelity Wealth Management for pension funds. It's a speculative position for funds with a high risk tolerance. This isn't an intelligent portfolio pick. This volatility is fueled by the company's own communications. On one hand, you have analysts like those followed by MarketBeat slapping a consensus $7 price target on the stock. That implies a 300++ upside from here. That's the expectation. They're basing this on a series of major announcements. First, a massive $150 million strategic investment agreement with Scilex Holdings. Second, a global technology license with Nature's Miracle for a carbon credit tokenization system, which includes a $2 million fee plus a 35% royalty on gross revenue. That royalty stream alone, if it ever materializes, could be enormous. Third, the recent letter of intent to acquire NYIAX, a blockchain-powered advertising exchange. And fourth, the company's own Q2 2025 earnings, which showed a 467% year-over-year revenue growth. All of this paints a picture of explosive growth. This is the narrative that gets traders on the Robinhood app and those using SoFi Active Investing to hit the buy button. But then you hit reality. And the reality is that this $7 price target is built on a mountain of ifs. That 467% revenue growth, it was almost entirely fueled by their acquisition of CompuSystems, or CSI. It wasn't organic. This is a classic roll-up strategy. Buy revenue to make your top-line numbers look good. The market is smart enough to question whether this is sustainable. Then there's the guidance. In one breath, the company guides for $40 to $50 million in 2026. In another, a press release suggests a path to over $200 million. This kind of discrepancy is a massive red flag. It creates uncertainty, and the market hates uncertainty. It makes it impossible for an analyst at Fidelity or a portfolio manager using the Interactive Brokers trading platform to build a reliable financial model. This isn't Tesla stock, where you can debate margins and delivery numbers. This is a black box. You're not just betting on their AI, you're betting on their ability to integrate NYIAX, API Media, and CSI, all while managing a new carbon credit platform and a $150 million financing deal. The execution risk is staggering. This is where the story of expectation versus reality becomes so sharp. The expectation is that AI in the name means it's a tech company, but the reality is that this is an acquisition and licensing vehicle. Let's briefly cover what Datavault AI actually claims to do. It has two main divisions. The data science division is where the AI lives. They talk about their information data exchange, which helps create digital twins and manage licensing for things like athletes' name, image, and likeness, a hot-button issue. This is their Web 3.0 play. Then there's the Acoustic Science Division, which holds patents for WISA, ADIO, and Sumerian. This involves wireless high-definition sound transmission and even ultrasonic advertising. It's a truly bizarre combination. Is this a focused tech company, or is it a patent-holding company trying to bolt on enough disparate businesses to look like a high-growth conglomerate? The market, with today's 4.6% drop, seems to be leaning toward the latter. This kind of stock is poison for most forms of traditional online investment. If you're a self-investing proponent who believes in long-term value, a company like this is a puzzle. How do you value it? The price-to-book ratio is around 1.16, which some value-oriented investors might point to, but in a company with so many intangible assets, acquisitions, and goodwill items on the balance sheet, book value is almost meaningless. You can't just plug this into a Fidelity trading platform screener and get a clean answer. This is where you need serious investment help. You're not buying a piece of a predictable earnings stream, like you are with Apple stock or even a broad Fidelity ETF's position. You are buying a collection of lottery tickets. The NYIAX acquisition could be huge. The carbon credit royalty stream could be a gusher. The AI-driven data platform could become the standard for NIL. Or all of it could fail. The acquisitions could be a mess, the financing could fall through, and the royalty stream could generate nothing. That is the binary risk you are taking. Let's look at the macro picture. We are in an environment where capital is no longer free. The Federal Reserve's actions have made it very clear that cash-burning, speculative companies will no longer be given the benefit of the doubt. This puts tremendous pressure on a company like DVLT, which is clearly in an aggressive, investment-focused growth phase. That going concern notice in their 10Q filing isn't a joke. While management has proven they can secure capital as seen in their financing rounds this year, they are on a treadmill. They must keep raising and keep acquiring to feed the beast and justify the narrative. This is a dangerous game. It's the exact opposite of a stable company you'd park in your Fidelity IRAs. This is a stock you'd trade in an individual brokerage account with capital you are fully prepared to lose. This is why platforms like Interactive Brokers, known for their appeal to professional traders, are probably seeing a lot of activity on this ticker, as are the Robinhood fractional shares buyers who are just trying to catch a piece of the momentum. So, where does this leave us? The future outlook is a spectrum of wild possibilities. The bull case is that management pulls it off. The 7.0G target is hit. They successfully integrate their acquisitions. The $150 million from Scilex closes, and the royalty checks from Nature's Miracles start rolling in. The company becomes a legitimate, albeit complex player in data monetization. The short sellers who have already been squeezed once as short interest fell 78% get completely wiped out. The stock rips past its 4.10 high and never looks back. This is the story the bulls are telling themselves.